Hello and welcome to The Farm. On the show this week, trust and ethics. Why Indian companies are putting their faith and assets in Singapore-based trusts. And the giant slayer, Sheriff of Wall Street and the public prosecutor with a funny bone. An exclusive interview with Preet Bharara, the US District Attorney, who's cracking down on insider trading.
It is my view, and I think it is the Justice Department's view, that no institution is too big to prosecute. Typically, when agents go and arrest members of violent gangs or organized crime figures from one of the La Cosa Nostra families, they don't faint. The same is not true of white-collar defendants. In a recent case, there were newspaper articles about how the jury that convicted that person, one of your peers, former peers, was crying at the moment of the verdict. That, to me, tells me that the justice system is working.
First, the trust story. Burdened by substantial debt, Reliance Communications has for some time now wanted to unlock value in its undersea cable business, a business that we've referred to all these years as Flag Telecom. Now, for a variety of reasons, Flag could not go the vanilla global equity listing way. Now it wants to go public in Singapore via a trust structure. Why Singapore? Why trust? Lyson Upadhyay goes in search of some answers.
In 2007, Ascendus India Trust went public as Singapore's first listed business trust holding Indian IT park assets. In 2008, Indiabulls Properties Investment Trust listed on the Singapore Stock Exchange with commercial property in Mumbai as the underlying asset. Just 2 months ago, Fortis Group-owned Religare Healthcare Trust received an eligibility to list approval from the Singapore Stock Exchange. And this month, Reliance Communications-owned Global Telecommunications Infrastructure Trust filed an initial prospectus with the Monetary Authority of Singapore to list its undersea cable business. All sign of the growing popularity of this route. Before we get to the why, here's the how. In a typical business trust structure, the Indian company creates or uses an overseas subsidiary as a sponsor. The sponsor incorporates a Singapore-based company as trustee manager. The trustee manager owns and manages the assets, the economic interest of which is sold via units of the trust, also established in Singapore. The units are listed on the Singapore Stock Exchange.
It is essentially a hybrid structure that has the elements of both a trust as well as a company. Okay, like a company, a business trust is established to run a business. However, it is not a separate legal entity. It is actually constituted by a trust deed. Under the trust deed, the trustee manager, which is the single responsible entity for the business trust, actually has legal ownership of the assets of the trust and also manages the assets of the trust on behalf and for the benefit of the beneficiaries of the trust.
If a company has a plan of a total of 8 assets, say 8 ships. 2 ships it already has and which are generating sort of revenues, and another 6 ships have been ordered but not yet delivered. It would be tax inefficient to move 2 ships to another company in India and try to list a company with just 2 ships. But there are investors who are willing to invest and hold these 2 ships which are generating regular income. And remember, there is no assurance that a company which has 2 ships will give you return. It finally depends on the dividend policies and other growth policies of the company. But the business trust, by definition, tries to return money to the investors. In this environment, investors want to ensure that their capital grows and they don't want to depend on the fluctuations of a market. The business trust gives them that sort of comfort, and therefore that business trust is able to buy out these 2 assets as compared to a company whose shares have to be listed and there's no guarantee of return.
That by far is the biggest attraction a trust holds, that it can offer fixed returns.
For a company to declare dividend, the typical test is where you have an accounting profit. So you could have a very lucrative cash generating asset like a ship, but you can't declare dividends on to your equity shareholders because of the accounting rules and the Companies Act requirements that limit your ability to declare dividend, because you don't have an accounting profit for different reasons. Whereas in the context of a business trust, to the extent you meet the Singapore Business Trust Act solvency test, you're able to declare dividend out of the cash flows that your assets are generating, even though you may have an accounting loss at the end of the day.
For instance, Reliance Communications owned GTI Trust is offering unit holders a yield of between 9.5 to 11.5% in FY13 and 10.1 to 12.2% in FY14. Besides fixed returns, investors are drawn by a higher degree of governance requirements in trusts.
These are actually more stringent and set a higher standard of independence compared to companies which are listed on the exchange. All right, so these will include the requirement that a majority of the directors must be independent from business and management relationships of the trustee manager. That's one. Secondly, a majority of the directors need to be independent from a substantial shareholder. And finally, that 1/3 of the board will need to be independent from management and business relationships of the trustee manager, as well as every substantial shareholder of the trustee manager.
And the third thing going for the Singapore Trust route is tax incentives.
The business trust is actually subject to income tax like a company, all right, but where the businesses are able to apply for and obtain tax incentives, it would be useful. So for example, certain shipping enterprises are able to obtain tax incentives. So that's why you actually have shipping trusts that have been established as business trusts, because you can utilize that tax incentive. You also have infrastructure tax incentives.
Investors who have a specific sector focus like infrastructure or real estate in some cases, investors who are long-term players in the market, private wealth investors who want to maximize the return from their investment would look at this as a fairly robust type of investment for a long-term return on capital.
On the India end, any overseas trust structure must first pass muster with RBI's Overseas Direct Investment Regulations. In fact, that's why the need for an offshore company as sponsor, because an Indian company cannot directly establish an offshore trust.
There's a limitation of 400% of your net worth that you can invest in such an offshore subsidiary. So there's a restriction there. And thirdly, because you're setting up an offshore subsidiary which then invests into the trust, in the units of the trust, that would then probably classify the sponsor as engaging in financial services. For a company engaging in financial services, there are further requirements that are laid down, restrictions that are laid down that are to be met under the ODI regulations, i.e. It needs to be an entity that's registered with a regulator in India. It needs to have taken prior approval of the regulator for engaging in such activities. It is required to meet certain prudential norms with respect to capital adequacy, etc.
In creating this entire structure, I think companies and Indian promoters need to be careful about ODI and round-tripping issues. This may also sort of depend on where finally they want the structure to be. That's the first sort of issue from an RBI perspective and FEMA perspective that you need to be careful about. The additional issue is from a tax perspective. All these structures will need a detailed analysis of tax laws, and how GAR finally sort of ends up is also going to be an important point on future transactions which rely on the BT structure.
It's early days, both for Indian companies and the Singapore Business Trust market, as currently only 9 such instruments are listed on the Singapore Stock Exchange. In 2007, Ascendus India raised $325 million from its Business Trust IPO. For Indiabulls, it was $193 million. Fortis and Reliance Communications are set to test the market soon, hoping to raise over $300 million and up to $1 billion respectively. Question is, will investors be enthused? In Mumbai, Paiswini Upadhyay.
Early days yet for Singapore Trust, and maybe not the right environment to experiment in, because ironically, right after we finished the story and just before we went on air, Reliance Communications announced that it's putting its Singapore IPO on hold, awaiting more appropriate market conditions. All right, with that, we'll take a quick break. Up next, the giant slayer, Sheriff of Wall Street, and the public prosecutor with a funny bone.